Hello everyone, happy Memorial Day, and I hope you are enjoying a long weekend. Markets are closed on Monday the 27th, and I'm still here, Julius de Kempenaer, to try and paint some color on what's going on in sector rotation. I guess that's the best way to describe this video. What I want to do today is look at a comparison between market cap weighted sectors and equal weight sectors. Most of the time they rotate in tandem. Sequence is the same. Positioning of the sectors on the RRG is quite similar. But when you see differences occurring, that's when you can learn something from these rotations. So let's start with a look at the cap weighted and equal weighted RRGs of S&P sectors side by side. Here we have the equal weight version on the left and the cap weighted version on the right. And if we just let's quickly go over the individual sectors and see if we can get a first glance of what's going on. So what I do is I rank them on their names, so we will be able to very quickly put them side by side. And here the first one is already one of the most interesting ones. It's communication services. Look at where the tail on the equal weight RRG is positioned. It's at a very low reading. It's coming out of lagging and it's pushing into the improving quadrant. It's at a good RRG heading. The cap weighted version, on the other hand, XLC, is inside weakening, curling back up and almost crossing over back into the leading quadrant. Way to the right, way to the left. Both at a good heading, but at a completely different position on the RRG. Because as you know, on the right-hand side is where we find relative uptrends, and on the left-hand side is where we find relative downtrends. So the cap-weighted version is in a relative uptrend, and the equal weight version is in a relative downtrend. The fact that they are both traveling at a positive RRG heading is in a way good news, because it means that XLC is basically starting a new uplag in an already existing relative uptrend. But RSPC, the equal weight version, is coming out of lagging, out of that downtrend, and that downtrend is starting to level off and starting to kind of improve. So clearly, very different behavior in both different tails. We'll get back to this later. Let's go to consumer discretionary. So here you see RSPD, which is the equal weight version, and here is XLY, the cap weighted version. Both are inside the lagging quadrant, both are traveling at a negative heading, but look at the positioning of XLY. It's around 96 and RSPD is about 99. And these tails are both 5 weeks, and you can see that RSPD only crossed into the lagging quadrant 1, 2, 3 weeks ago, and XLY already crossed back, coming from improving, it's crossing over here. So this is November 6th, and it's been in the lagging quadrant or on the left-hand side ever since. Quite a time. If we look here, it's only 2 or 3 weeks. So what this tells me is that the large cap stocks in XLY have been driving this market down, have been underperforming the S&P 500 big time, and that's why they are dragging that sector down. Much less so for the consumer discretionary stocks at a lower tier, but they are now catching up. So they're catching up with XLY. So the rest of the sector is now starting to move lower as well. And it's one of the things that we identified as potentially being dangerous or potentially a warning signal under the hood, because consumer discretionary is considered to be a very offensive cyclical sector. And that's a sector that you expect to do well when the market's going up. And market's still going up, although not all that enthusiastic since last week, but still going up. And you see a sector like consumer discretionary moving into the lagging quadrant and underperforming the S&P 500. That's, in my view, definitely a warning signal. We go to consumer staples. You see it quite similar. You see XLP inside improving, moving to the right. Not a lot of momentum, not much gain in relative momentum, but it's definitely gaining on the horizontal scale, on the RS ratio scale. And here we see RSPS, which is kind of in a similar pattern, although last week's movement lost a little bit of momentum, but it's still moving higher on the RS ratio scale. So consumer staples still improving. So here is energy and here is XLE. So those are quite similar, RSPG and XLE. Here's financials versus XLF, so RSPF versus XLF. And let me blow this up because this is a little, you can see how short these tails are. So that means that they're pretty stable trends. And here you can see how RSPF is inside weakening, making a little zigzag, stopped picking up relative momentum. And if we do the same for XLF, you can see how XLF now actually moved lower. So quite a sharp hook the last few weeks, pushing back into the weakening quadrant at a negative heading. So XLF is definitely at a negative heading. RSPF, not so much anymore. It's not in that 180 to 270 degrees. It's probably at like 270 exactly. Anyway, XLF rapidly declining and RSPF kind of in the same boat. I would say that RSPF is slightly better than XLF. Here's healthcare, RSPH versus XLV. And we see the little hiccup, the little uptick in XLV, which is not visible in RSPH. And that indicates that the strength for healthcare stocks is coming out of the larger names inside the healthcare sector, because that's driving the last few nodes is ticking up XLV. Those are the large cap names, because otherwise RSPH would have been ticking up as well, and that's not happening. So it's still moving lower on the RS ratio scale. So here is industrials versus XLI, quite similar, I'd say. RSPN leading a little bit, XLI almost crossing over, so not much change there, not much difference there. Here's materials, RSPM versus XLB, and here you can see how XLB is clearly rolling over. RSPM seems to be lagging that rotation a little bit, which indicates that it's the larger names that are rolling over. Not too much, but slightly weaker than what's happening in RSPM, but they are following through. Here is real estate, RSPR versus XLRE. It's interesting because here you can see how XLRE is still moving lower. It's actually the weakest sector on the plot in the cap-weighted version. And here you see RSPR still a low reading, but clearly picking up relative momentum, where XLRE is not doing that. So that means that the larger names in XLRE are weaker than the second, third tier real estate REITs, I would say. Now we go to technology. That's interesting because you can see how they are both traveling similar trajectories, but RSPT is lagging behind a little bit because you can see that it has only 2 weeks ago crossed over into lagging and then last week started to point up. XLK is inside the lagging quadrant for quite some time already, and that means that XLK has been leading. So the larger names have been leading the sector downward into the lagging quadrant, underperforming, and they're now starting to pick up. And the question is whether the larger names will now start to lead on the upside as well. And we need to track the relationship between XLK and RSPT to find out which segment inside the technology sector will be the driving force in the next couple of weeks. And then top it off, we've got RSPU versus XLU, and those are, I'm going to say those are the same. So inside the utility sector, and although it's a very, in terms of market capitalization, quite a small sector, so there are not real dominance from larger mega cap stocks, this sector is quite the same. But what is still there, which we discussed last week and which I talk about in my blogs all the time, is the strength for the utility sector. It's a long tail, which indicates that there is a lot of power behind the move, and it's moving into the leading quadrant and continues to move higher on the RS ratio scale. So utility is still on a roll, and I've received a few mails and messages from people saying that utilities might not be a defensive play because it is especially the data centers, so the electricity that needs to be provided to data centers and all kinds of new tech stuff that is creating the demand. Now, I'm definitely not an expert in that field, so I'm not going to make a judgment call on that. I think the comparison that we need to make is the demand that's coming from, let's say, non-residential use or small business use, is that so much smaller than what data centers and other technology need that it's been kind of overruled by that demand. And I honestly, I don't know. So until proven otherwise, until, I don't know, validated possibly, I don't know, I'm going to treat utilities as a defensive sector together with healthcare and staples, and to a lesser degree, energy. I'll update an RRG here in the coming weeks sometime with the beta values of those sectors, and you will see that utility still has a low beta. And that to me is also a sign that it is still a pretty defensive play. So that's, my comment on that, on those remarks. Another way of visualizing those relationships and making them, I think, a little bit more standing out is what I've shown in Sector Spotlight a couple of months ago, but maybe a few times already, is to create a relative rotation graph that combines the ratios between the cap-weighted and the equal-weighted RRGs. The cap-weighted and equal-weighted sectors. This RRG shows the relationship between the ratios between cap-weighted versus equal-weighted. So if we look at the tail here, that's XLY divided by RSPD. And the benchmark that I'm using is $1. And the reason for that is that I'm interested in the direction of the ratio. So this is already a relative, and I need to know which direction it's going. So in a positive rotation, in this case, it means that the cap-weighted sector is outperforming the equal weight sector. And when that happens, that means that the larger names in the sector are driving. So in consumer discretionary, the larger names are driving the sector higher. If we go to communication services, you can see that XLC is underperforming RSPC, or at least it's like rolling over and moving lower at quite a long tail. It has been, you can see how strong this relationship has been, how strong XLC has been over RSPC, but that has now ended and it's going the other way, at least temporarily. So in XLC, I would look at the second or third tier stocks, not the major names. And by the way, in XLC, that is Meta and Google, and especially Google, because Google has basically been driving the sector higher. And if you look at consumer discretionary, it looks as if the larger names are the driving force. Now remember, consumer discretionary as a whole is moving into the lagging quadrant. It's a really weak sector. If you need to be in consumer discretionary, you should be in the larger names because they are beating the smaller names, although the whole sector is moving lower. I hope that makes sense. And if we go over the others, here you can see the same for XLRE. So the larger REITs are underperforming the smaller ones. So you could better be inside the smaller ones, although the sector itself is not too good. Let's see what else we have here. So here's healthcare. Healthcare is being pushed higher by the larger names because XLV is moving in the right direction. Utilities versus RSPU, even though it is quite similar, you can see how the larger names are pushing higher. Same here goes for XLK for technology. The larger technology stocks are driving. Small mid-cap, smaller names are underperforming the larger names. And then here you see XLE, energy sector, in a zigzag move, very close to 1, which means that there's not a clear preference for either of those. And then here you can see the material sector, so that's XLB versus RSPM, and that is XLB underperforming, so losing out against the second or third tier of those stocks. Looking at it like this, looking at RRGs like this, bringing in different ratios, different relationships, can give you a different angle of perspective on what's going on. And as I said, for right now, I think that the biggest lesson that we can learn here is that in the communication services sector, it's probably best to zoom in or at least take a look at not Google, not Meta for potential opportunities. And in the consumer discretionary sector, although the sector itself is really a strong underperformer, the preference should be for the larger names. Same for healthcare and utilities. Oh, by the way, we didn't talk about consumer staples, but that's right here. So here you can see consumer staples pushing right up there into the leading quadrant, which means that the larger staples names are beating the second and third tier names. Again, a good way to visualize the relationship between market cap or cap weighted and equal weight to get a sense of which size segment of the market is doing better or worse than the other. You get an even better handle the difference between XLC and RSPC when you put the charts side by side. So we've got XLC on the left-hand side and we've got RSPC on the right-hand side. Look at the graphs. If you start at the low in 2020, they both show a very decent long rally where XLC continues. Let me put my highlight here. This continues until the end of August 2021. And if you look here, this one reaches its high already in March 2021. And then equal weight goes sideways until November. And as I said, XLC reaches its peak in August and then starts to decline. And then from November onwards, they both start to decline. And they reach a low somewhere in October, at the end of October 2022, 10 October 2022, so quite similar. So apart from the sideways move here in 2021, where XLC was a little stronger, the moves are quite similar. XLC dipped a little bit more. I think that you can see where the low is in relation to that previous low. The equal weight version stopped at a higher level. But what you see then is the big difference that started to show up out of the low at the end of 2022. They both move up to a peak in January 23, it's this peak right here, and then after break, this by the way is a very nice inverted head and shoulder, XLC breaks in May 2023 and just starts this magnificent rally, which technically is still there, and RSPC has done nothing. It's moved sideways. It hasn't even managed to break that January high, and that's all on the account of the large cap names inside the communication services sector. Now, when I put these on a one-on-one relationship, as I've done in this chart right here, and I am plotting a very basic technical indicator like the RSI, you can see that this indicator reached levels over 70 already early 2023 and remained there until November. Dipped back to 50 and then went back up. Divergences are a very strong sign, but I do believe that they are viewed or seen, they are seen more often than they really exist. It's the same like somebody who's just learned what a head and shoulders pattern is, sees a head and shoulders pattern everywhere. Or if you just bought a red car and you're waiting for delivery, all of a sudden you see red cars all around you. It's the same with divergences. So you got to be careful by calling something a divergence. And also, before there are definitely situations where there is a divergence present, but not necessarily executed. And that's a big difference. So basically, all this time here, you could have argued, again, let me put my crosshairs on here. You could have argued that this is a negative divergence. But before a divergence becomes meaningful, you need a signal in the chart. So here's a ratio chart, but when you look at a price chart, you need some sort of a break of a trend line, break of a support or resistance level, breaking out of a trend channel, a double top, a head and shoulders, a wedge, some sort of a pattern being formed. That is an execution in price. So your divergence is kind of a warning signal. You can't trade divergences. You need to trade price. So, this divergence here never executed. Same here, never really executed. And then you drop back. So another thing, and maybe it's me, but that's how I kind of picked it up and learned it. Some people will tell you that this is a big divergence all the way down here. I think that when the RSI drops back to, let's say, levels around 50, everything that happened before is void. It doesn't count anymore. So you got to recycle the whole principle of divergence again. And I think that what you see right now is much more of a divergence, because you can see how this line here is now declining. Those highs are really declining instead of being all at the same level. And what we need now is an execution in the ratio. What is an execution, or what would, for me, for someone else might be something different, but for me, be the execution in the ratio? I'd say here when we break below 275, or a little bit more conservative, 273. When you get this, when you get a peak here, and whether that is at the current level, or maybe it goes a little higher to 285, maybe even to 3, I don't know, then you will get an execution when we break below 275. So as long as the RSI here doesn't move above that imaginary trend line coming down here, let me plot that in for you. Annotate that chart, and then, so this here is the divergence that we're looking at together with what's happening here. So these peaks are higher, these peaks are lower. As long as the RSI remains below this falling trend line, and we got a new peak somewhere here, could even be a little higher than 285, and subsequently we break below this low here, that's when I would say this pattern, this peak is being executed, and you got a signal, if you want to call it like that, to prefer the second or the third theory. Because don't forget, we're looking at a ratio here. So we're looking at cap-weighted communication services versus equal weight. Right now, this is screaming large cap, mega cap. If this executes together with that RSI divergence, we're moving out of the larger mega caps into the smaller second tier segment in the communication services sector. I'm going to leave it here for this week. Thanks for watching. I hope you enjoyed the show. And thank you for all the messages that I've been receiving after not being online for 6 to 8 weeks here on the YouTube channel. Keep them coming. I promise you that I read all of them. I also read all the comments on the video, so please don't hesitate. And if you didn't get a response, I'm very sorry. In the end, someday you will get it. I've tried to respond to most messages, and I will continue to do that. But there is a limited amount of time in the day. I hope you understand. Again, thank you for watching, and looking forward to seeing you again next week here on the Stockcharts YouTube channel. Same time, same place.